Welcome back, everybody. Today we're going to be talking about a hot topic, and that's how the new insurance restrictions are affecting your commercial real estate investments, actually residential too. So for that, I've got Mark Fuchs in here. Mark comes in quite regularly and talks about insurance. George Pino, CEO of Commercial Brokers International. I guess the CFO today.
Depends on what hat I'm
on. Depends on the
talking
time
money, so he's the CFO.
Yeah, exactly. Here to walk us through this because we own property. We've taken a hit on a few of them, but I thought, this is a pretty tough topic, and so I really wanted to break it down for you. So, Mark, thank you for taking the time coming in.
My pleasure.
Why don't you give us a 30-second background of who you are, what you do?
My name is Mark Fuchs. I've been in the insurance industry for over a decade. Our firm's been writing insurance here in California for over 40 years, commercial and residential. So we're very much at the forefront of this, and we just actually had a meeting with our regional rep to tell us what kind of business we can't do.
Let's start right there.
Yeah, okay.
What did they tell you? This is just for California, right?
This was just California. Well, not just California, but our parent company, I'm not going to say their name, came in, and they are limiting us to one homeowners, one fire policy, no new autos here in California. And I asked about other states. No Florida, no Nevada, no Texas. Any new property or policy.
Wow.
That's tough.
On the residential side.
So, and I want to come back to this, but what is their game plan? Why are they just cutting this off?
Well, what they told us is that they are still here in California because during the pandemic, nobody was able to raise rates. Right. Some of them were even forced to rebate on auto policies because they were charging them, for mileage that wasn't being driven. Right. Yeah. So what's happening right here in California, and we spoke about this before, is a lot of these companies are still operating on 2019, 2020 rates. So,
and the whole dynamic of the industry has changed so much with the homeless issues as well as break-ins, robberies, the everything. So I can completely...
Well, cost of labor. Like the cost of labor, supply
construction
chain.
costs.
They say automobile repairs is one of the number one inflationary things right now.
Really?
Yeah, and the fraud in that area doesn't help. Insurance fraud, which they don't want to talk about. But
okay, so that's why they're not writing anymore, is just the costs.
It's the cost. They're losing money.
And the risk.
Yeah, they're losing money.
Yeah,
they're losing money. And right now, we're hopefully going to get an answer on our rate increase in October, which even she said that even if we get the rate increase, doesn't mean we're just going to go back to normal.
Go back.
Well, I put a post out last week that got a lot of people heated about why these insurance companies are dropping people, and they said they've made billions. So, but I'm hearing you say these companies have maybe made millions, but they end up losing in the end.
Well, if you remember, we did a video a while back where with all these disasters that the insurance companies have taken out or paid out claims of $220 billion over the last 3 years with all these disasters. So yes, they're in the business to make money.
Yeah.
So if they're in a market where they can't make money, they're pulling out. Simple as that. It's just like, would you operate a business where you keep losing money?
Yeah, you can.
Yeah.
And I want to end at the end of the video, which, by the way, if any of you folks have any questions for Mark or George or myself, put it in the comments. We will get back to you. But, and like Mark said, we did a video, what was that, like 4 months ago? Yeah. Probably 4 or 5 months ago. You can go back and see that. Maybe I'll link it down below as well. But I want to close this video out on where you can go. So I want to really remember to close it out with that. But right now, I'm hearing people that did that post last week, and they're saying my insurance has gone up 30, 40, 50%.
Yes.
Are you seeing that as well?
Oh, yes. And when you can get it.
Right.
I've seen some quotes as high as 300% more than it was the previous year.
Well, I have a couple examples of that on the commercial side, on buildings, right? But just on your personal. And what you're seeing, and I think we spoke about this in one of the previous videos, the worst thing you can do right now is get not pay. Oh. If you get canceled for non-payment, nobody will reinstate you.
So there's no leeway. So
there's no leeway.
It's due tomorrow.
It better be in there tomorrow.
It better be in there. You'll get canceled.
Yeah, we had an example of a client that would have been for 20 years, 20-year client.
With the same insurance company.
Same insurance company, missed a payment. Agent called to say, oh, no big deal, 20-year client. And they said, sorry. So who knows? So have it on auto pay wherever you can.
And check your auto pay. Yeah, don't just trust that.
And we have a lot of people saying, oh, I didn't get the notice in the mail. Yes, you did, 30 days before your renewal.
Oh, okay.
So that doesn't work.
Yeah, they don't care.
They don't care. They don't care. They're almost looking for reasons to not cover. almost, it seems like. And the problem is that they're all battling the states
Right.
to raise rates so they can get back to a more profitable model.
Right.
And even when they do get rate increases, a great point is Wawanesa, which it's I believe they're Canadian, but they sold their U.S. operations, which was mostly California, to AAA earlier this year, and that was after they got approved for like a 29% rate increase.
That's probably why they did.
Yeah.
Got out with.
Well, it still takes
Wawanesa
them, months to like almost more than a year to get back
implement that and
well,
go
to,
back
yeah,
in.
to get back in the black and collect those premiums.
Sure.
And what you're seeing in some is what's a very hard thing right now, and you're seeing it in some in commercial, but more so on the residential side, is that they're not allowing the payment plans. They want payment up front.
That's it. Huh?
Yeah. So like for budgeting and doing your, your monthly budget, your cash flow statement, whatever. So if you've got that sunk cost up front, now you have to collect rents or whatever.
And this is on commercial as well?
You're seeing some on commercial, not so much, but
It'll
more on.
probably catch on there.
It will.
You
It
know,
will.
so you're going to really want to budget for it. You know, if you can't break those payments up.
Well, especially if you get non-renewed.
Yeah.
If you get non-renewed, they can pretty much dictate terms.
Everything that they would want.
Whatever they want. They say, you want the coverage? This is what it's going to be.
All right. I know you said you had a couple of examples. Why don't you walk us through them?
Well, we had a couple. Well, do you want to go through the
Sure.
questions? Okay, so one of the things we were talking about, or George and I were going back and forth, is the major challenges right now for landlords with regards to insurance. And like we just touched on, cost, they're going up. They're not coming back down. Regional avoidance from certain carriers, like the thing we talked about last week, that we had 5, those Gulf states, the Floridas, the Texas, the Californias, that have the disasters, the fires are going. And then with that, the updates and expenses that you need to maintain your coverage. Because now when they're coming in, and we've spoken about this, if you say, oh, I redid my roof in 2010, they're like, okay, great, let me see a receipt.
Yeah, because you used to be able to just say, I just
Oh, we would just say, like, a lot of times I would just, honestly, just like, oh yeah, I've seen the building, I took pictures probably 8-9 years ago.
Right.
I'd literally make up
Yeah.
a year.
Yeah.
Seriously. I mean, especially
So now you have to have proof.
Yes, you have to have proof. And then like,
So hold on to those receipts.
Yeah.
hold on to the
Seriously.
receipts. Yes, do not, have those receipts, have the whatever, but, and then what we talked about is California, Florida, New York are the toughest right now for commercial, and the Gulf region of Texas.
Sure.
And
Okay.
those are the ones, and the ones that are really tough are habitual, your apartment buildings. And if you have like maybe a commercial building that you lease out, and you just have like a fire LRO policy, and the number that I was thrown out to me was $4.5 million. So if you have a property that's going to cost more than $4.5 million to rebuild, so those are some of your bigger places, maybe a shopping center, maybe a large warehouse.
Yep.
When you go in to make one of those deals, make sure you can get coverage, because we've had companies out here, like they just flat out, they don't want warehouses. Don't even care what the
Just don't
tenant
want
is. I don't care if you're like perfect OSHA record, whatever. They're just like, yeah, we just don't want warehouses.
Okay.
You know?
Yeah, no, and typically with commercial real estate, a lot of the leases have clauses in there, so a lot of it can be passed through as far as the increase. Now, I think ultimately, though, it's a combination for landlords to understand that, even though the lease may allow for you to pass through that, your current tenant may not be able to afford it. So you may actually have to eat it or lower your rental rate
Right.
just to compensate for the increase in the pass-throughs to do that. Or you may run a risk of a higher vacancy rate. More importantly, I think the habitual, such as the apartments,
Yes.
you can't pass that through, typically speaking. And right now, especially with rental rates going down, if you're looking at a 200-300% increase in your insurance costs, that's going to affect your bottom line heavily. And for every dollar on today's cap rate basis, for every extra dollar,
Right.
you're losing approximately $15 to $20 in value.
I believe that.
Yeah.
I believe. I mean, like up until like recently, like you said, we finally saw like a little leveling in
Sure.
rents. Is that they were just passing those costs through. But right now, and who knows what's happening with the economy? How is student loan debt? It has to start being paid again.
Yeah, it's
So
started already, yeah.
So yeah, so like if you're looking
Just
at a
started.
building near a college, which has always been a great source, because you have students coming in every year and rental, but now if all of a sudden some of them are now having to restart paying that debt back, Their costs are more expensive. Their car insurance, their health insurance, everything's more expensive. So it's going to be, you're going to have to really, get out that pencil and go through those numbers to see if that deal makes sense. And
whether it's sustainable or not based upon the projections that you've made, because these are things that everybody I know know how I do my underwriting,
right.
and I know how most investors do their underwriting, and
Right.
a lot of times they're not necessarily underwriting. We are underwriting for increase in expenses, but nowhere near on the percentages that we're
No.
looking at across the board when it comes to not just the insurance costs, but utility costs, maintenance costs, cost of construction,
Sure.
repair costs. All that has skyrocketed dramatically. And then when you're in a rent control situation, like a lot of California,
Yes.
you can't raise the rents enough to compensate for that increase. So you're actually losing money year over year
Yes.
in this scenario.
Well, that's what they said. Our cost of reconstruction.
Yeah.
The number one thing is the labor cost.
Yeah.
Like, last year when we had the supply chain issues, it was the materials.
Yep.
But now it's labor.
That's labor.
I mean, think about it. Those labor costs have gone up, what, 30, 40,
Yeah.
50,
Yeah.
60%?
I would think so. I mean, just breaking news today. $20 for fast food minimum wage.
Mm-hmm.
So if a fast food minimum wage cashier is making $20 an hour, I can only imagine what a carpenter's going to want.
Yeah, 50, 60,
So-
yeah.
I know when I paid to have some carpet.
Yeah, exactly.
I fell through the floor. All right.
Exactly.
What's the next question?
So
Yeah.
one of these things what alternatives does this leave a landlord, right, in regards to insurance carriers leaving the market? And the bottom line is it leaves them with fewer options,
Right.
to obtain coverage. And this is where maintaining your building, maintaining your loss controls, to make sure that you are almost like a perfect candidate for them to write, because if there's fewer carriers writing, one, they can pick and choose who they want. Their underwriting guidelines are going to be a lot tighter. They're not going to want the older buildings. Older buildings are the ones that scare me the most, especially where we are here in the Santa Monica area, where
Oh,
this
yeah.
60, 70, 80, 90-year-old
Old
buildings,
yeah.
in which I know they have those on the East Coast too as well. But for some reason out here, there's a lot of major companies that won't write a building that's over 40 years old,
Right.
over 50 years old. And you start looking at that and you're like, okay, 50 years ago was 1973.
Yeah.
And you're like, okay, this whole area was already built in 1973.
Oh, yeah.
So unless it's been torn down, and with that, you're going to see the higher premiums, the tighter underwriting. And what it's going to do is not that these are bad companies, but it's going to force people into the non-admitted area,
Which is
and
going to
market,
be.
which is going to be more expensive, right? They're still A-rated companies. People get scared away like, oh, it's non-admitted. It means they're not a good company. No, it means they just haven't decided to, deal with the laws and commission,
Sure, right.
Insurance Commission of California or your state
Right.
to want to do it. Doesn't mean they can't.
Yeah.
And if they're going to them, they already know
Okay.
you've gone through A, B, C, D, E, F companies and couldn't get coverage.
Right.
Yep. Now, what about forced insurance? Because I know a lot of times lenders will, if you can't find insurance, and you have a loan on your property, whether it's commercial or residential,
Right.
they're going to do what they call forced placed insurance, where they place the insurance on themselves. I don't know. Some lenders, I think, may actually self-insure a little bit, but others typically have
It's going to depend on the property.
Okay.
Okay, so forced coverage is, unfortunately, we had a case with that out here last year. A customer that we wrote their policy 4 years ago, and like any good businessman, he actually got a cheaper rate than we did a few years ago, but then he came back to us. I was denied by 13 different carriers, and finally the bank had to go, and this is at a college housing in Riverside,
Okay.
that now all of a sudden was fire zone, which we wrote it for 7 years and it wasn't fire zone.
Right.
So,
that
there was a
changed.
fire out there.
Remapping.
Yeah, remapping.
Yeah,
So,
remapped it.
and he had a lender out of the East Coast, and I think his policy, it was a big 14 small buildings, 90 units, so it was a big premium, like in the
Sure.
mid 30,000 range. And I think when I reached out to him with the forced coverage, I want to say it was like 60.
About double.
Yeah, about double, and it depends on the area you're at. And as you said, the one thing is that if you get forced coverage, the minimum they will do is the balance on your mortgage.
Yeah.
So let's say, you have you bought a, somewhere out here, a more expensive area, you paid, $1.5 million for a building, right? That you have $1 million loan against. but your cost of reconstruction or your coverage before might have been $900, $950.
So let me just for clarification and understanding.
Yeah.
What you're telling me is that if a lender forces insurance, they're only worried about their money and the equity that they have placed on the debt side.
Yes.
And if there is a catastrophic event, the lender's probably going to be made whole.
That's right.
But
You're done.
the owner's probably done.
Right.
Yeah.
All right. Just want to make sure
Yeah,
everybody's clear
if
on
they're
that.
going to force the coverage, I mean, you as the borrower, if you want to pay for it, can say, if you're forcing coverage, I want this much building coverage.
Yeah.
Right? And it's going to be very expensive, but
Sure.
the lender is going to protect themselves first.
Sure.
Correct.
Yeah, because I put that post out last week and it got a lot of attention, and people said, "I'm just not going to carry insurance anymore." And I said, "I don't think that's going to be a good alternative." But
I mean, you can. I mean, if you want to self-insure, if you own the building outright, that's a personal choice.
Yeah.
In an area,
Or if you're McDonald's.
or something like that. Yeah, I mean, yes, you could. I wouldn't recommend it.
Yeah.
Because especially if you want to take the risk for the building, great. You definitely want to have some sort of liability or something there to protect you as a building owner and make sure they don't come back at you.
Yeah.
So, but so with that, I brought out 3 examples. Here on the in the LA region where we're based. So here's an example. Here's an 8-unit building. It's a little older, 1954, in the Los Angeles technicals. And paid $5,400 last year, went to $9,700 this year. One here in Santa Monica, 10-unit building, 10,000 square foot building, 1967. They paid $5,100 last year. We got a quote for $15,000.
See, now that being in Santa Monica, the restrictions on the rent control and that, you got to be almost losing money.
Yeah, I mean, it's like, I don't know how, if they've owned the building outright.
Don't you think?
Yeah.
Yeah.
I mean, think about it.
If it's a 10-unit building, you can estimate that, realistically speaking, with the increases, you're only looking at probably about $250, $300 a month in total increases on a rental rate basis on current what they're allowing. So over the year, that's $3,600, but you're paying an extra $10,000 in insurance.
Yeah.
So yeah, you are losing money
Yeah.
if you can't pass through.
And then I went to another region
Yeah.
here in the San Fernando Valley, another 6-unit building, 1954, small building, 4,100 square feet, but they went from 6,300 to a little over 13,000. So again, more than double. But now, like the one that went to 15, that person, actually, I haven't dealt with them, but they went to a company called Honeycomb, which is an online quoting service. I don't know who they underwrite with or who the carriers are, but they were able to obtain coverage for less than the 15 that we had quoted.
Okay.
I don't know how much less, but they definitely still paid probably double, but it was a definite. There are places that you can do that, and with this world, what some of they're doing with their underwriting is more like almost like an AI based underwriting. They're searching the internet for any kind of history, pictures, mapping. So I think what it is they're using technology to have less staff to bring their costs down a little bit, and that way they're not, and then you're going directly to them, not through an agent to do it for them. So if you're savvy enough and you've been doing it long enough and you're a good investor, you have an understanding of insurance, and you can do it. A lot of people that have been, dependent upon like, a good agent to do the homework for them, make sure they're in compliance, give them updates, because the problem with that is then one, that's just you with the insurance company.
Right.
You don't have me to fight for you, or to like, if anything comes up, to be able to come up and say, hey, Joe, by the way, you need to take care of this in the next 3 months, whereas they might just send you a notice and you may not open it or may not read it or something. And, one, you can save money, but at what cost? Are you really saving money?
Yeah.
So, I'm sure they have A-rated carriers and that, but, there are sources, and you're probably going to see a little more online business that are trying to do that. I just don't know the long-term effect of how that... what kind of service you're going to get.
Right, yeah.
So
I've not heard of Honeycomb. So they're just, you go online, you can find them.
Yeah, it's just like
honeycomb.com.
Yeah, and I think you can click it in and somebody emails you back and, Yeah.
and get your new rate.
Right.
Where else can these people go that are getting dropped like this? I mean,
Well, the unfortunate thing is that in some areas, like if you're in any kind of brush, or now like in the East, like if they
Yeah.
deem it a hurricane zone or
Wildfire,
flood zone, wildfire,
hail.
tornado alley,
yeah,
every state here in California, it's called California Fair Plan.
Right.
And it's like, the insurer of last resort.
yeah.
And those rates have gone up 100% across the board
It's
for
super
those.
expensive. So I'm guessing every state.
Every
has that.
state has their own version of that. But then again, now we're also talking about a state-run plan,
Yeah.
which, that could be your own political aspect of like how you
Yeah.
trust the government to run a program, right? But also, service-wise, again, how are they staffed?
Right.
The cost, and also how solvent are they?
Yeah.
And there's probably also limitations on what you can actually insure as well.
California, the limit is $3 million, and they just increased that 2 years ago from $1.5 million.
Wow.
So this one that I had that I got denied, it was like 14 different buildings with different addresses. So Mark's thinking like, oh, I'll just go to Fair Plan and write each individual building. So I called, and Fair Plan said, no, that's all one complex.
Oh.
Because the total building value we were insuring for like over 14 million.
Yeah.
So I'm thinking like, oh, I'm smart, and they went, no, not so fast.
Not that smart, Mark.
So it was,
good to know.
it's like, yeah, you could have, maybe tried to force it through, but all they would have done is bring up a map.
Yeah.
I would have seen it, and then it would have been denied. And then I'm looking bad by telling my client, oh yeah, we'll just write it like this, and then no.
Yeah, we actually ran into that a little bit. Joe and I, we actually owned a 9-unit, an apartment building or apartment development in Dallas that had 9 buildings, and they remapped, and they decided that 2 of the buildings were in a flood zone.
On a hill.
On a hill.
On a hill.
Yeah.
Oh no, I've been to that building. The
Yeah.
creek behind that's like
with the creek
50 feet below. Yeah.
Exactly. That the Army Corps of Engineers just completely redid so that there's no chance of flooding.
Yeah.
But we had to pay flood insurance for that.
No.
That was an extra chunk.
Well,
Sure.
okay, but too, also you guys dealt with that, and probably a lot of people that are not here in California, but it's becoming more prevalent here in California, is flood insurance,
Oh yeah.
which was, run by National Flood. And after a lot of those really bad floods in the Midwest, like 5, 6, 7 years ago, flood insurance used to be really cheap, run by the government, and all of a sudden they went, yeah, no, we're losing money. So those prices increased over 100% a few years ago, and it's interesting because a lot of people don't realize that, and that's why those Gulf states and the hurricane areas, it's because most people don't realize water flooding isn't really covered on your basic policy. If it's a pipe bursting or something like that inside, that's one thing, but if the rain builds up, like you don't have good landscaping, good drainage, and it builds up on the outside, that's poor maintenance, they're going to deny those claims.
Yeah, absolutely.
So you have to be, that's why like going to a honeycomb, like it's great, you can save money and maybe a temporary fix a la Band-Aid, and I don't know enough, but to really like have somebody working for you.
Yeah.
You run the risk of, you think you're covered, but you may not be.
Right.
Yeah.
Right, and what perils are covered, what's not covered, and who's going to read their policy, that 100-page policy that, if you have insomnia, just pull just pull out your insurance policy and start reading it. You'll get to about page 5.
Yeah, be done with it.
So it's getting challenging.
Yeah.
It's getting
To say the
challenging
least,
for
expensive.
us, the building owners, the investors, the agents, and that's why, like you and I have talked about with the agents, like, make sure you're doing homework up front. So when you're presenting a property or an opportunity to a client, is to know what everything they're looking into. Not just oh, here's a building, it's a great neighborhood, great traffic, great whatever. How's the insurance costs? And like I think you made a comment before, is the pass-through part. Because you got to remember, your tenant's insurance is also going up.
Yeah.
Yeah.
So that's another expense they're dealing with, not just yourself.
Yeah.
So I mean, they're coming to a head. Rates are gonna go up, but I mean, just this labor costs, material costs, everything is.
Do you think when inflation comes down that the prices might come down?
No.
No, they're going to stay right where they're at.
No.
Yeah, once they go up, they're not coming back.
Yeah, they're not coming back down.
Yeah.
They're not coming back down. I mean, when was the last time you saw a rate decrease?
No.
No. I mean, the only time I've ever seen it is when they forced companies to give back some auto premium during the COVID.
Yeah.
And that wasn't much.
All right.
You'd have a $1,000 policy and you'd get a check for $75.
Yeah. Well,
look how kind we are.
well, Mark, any closing comments?
My best thing to do is one, just be on top of it.
Yeah.
Never let it lapse, and start your renewal process as soon as you can. Typically, they send it out 30 days ahead of time. Start sending in that paperwork now so you can see, and also too to see if how much they're going to increase, if they are going to increase, and like they don't like if you're going to get non-renewed or canceled, you'll get that notification. But prepare yourself.
Yeah.
Prepare yourself.
Do it ahead of time. So if it gets lost in the mail, you got time to get it back out.
Right. Well, that's
yeah.
But yeah, submit it. Submit your renewals as early as possible so you have it in place, because you do not want to get to like 7 days out and you don't have coverage yet, because you're going to be in for a rude awakening.
Absolutely, because and I think a couple things I can add a little bit. I would also make sure you have all your loss runs. Every year, just request it. That way, you're ready. Just update it. You have it, and this way, if you are behind the 8 ball a little bit, or maybe they're busy, because there's a catastrophe. We all don't have a crystal balls. We don't know what's going to happen in the future when the insurance policy comes due. The last thing you want to be is behind the 8 ball trying to find that last year's loss run, and nobody can quote you, so you end up
right. And a lot of those, I mean, like I do that up front is like sometimes even if we're the agent. Sometimes the owner has to request them.
Yeah.
It's not always like, even though I write your policy, sometimes, certain companies, I have to say, hey, Joe, you need to email this, your company at this and ask for the loss runs. And they say 24 to 48 hours. Most are pretty good, but like, we just went through Labor Day. Like if you had, something coming up on the 1st near a holiday, like those, like take all those dates into account, weekends, those companies, trust me. I mean, Labor Day, I mean, we're getting notices. We're closing the office at noon on Friday, and we'll be back in the office on Tuesday. So if you had something due on the 5th and you weren't on top of it, now all of a sudden you come back and you've got a day. 2 days.
Drive it in. All right. Well, Mark, thank you very much for coming in. George, thank you for coming back over.
Absolutely.
For those of you watching, thank you very much. I hope this was very informational. Again, if you have questions, put it down below. We'll try and get it to you. And give us a like, and if you haven't done so, make sure you subscribe.